Hello, everyone. I'm Shayla Taylor, and I will be your host for this informative session on funding the business. Before I start, I have to sincerely thank our sponsors, Rooted in Good, for supporting Women Grow's narrative and platform. Today's topic will discuss the realities and inequities of funding in the cannabis business. The cannabis industry faces funding obstacles due to federal regulations, banks' reluctance to work with cannabis related businesses, high risk perceptions by investors, and varying state laws impacting marketing stability. Additionally, limited access to traditional banking services can hinder growth and investment opportunities. Individuals in the cannabis industry often secure funding through private investors, venture capital firms specializing in cannabis, private equity, crowdfunding, or through partnerships with established companies. Some may also explore alternative financing options like angel investors, family offices, or cannabis specific funds to support their businesses. Additionally, there are specialized lenders and financial institutions focusing on cannabis related businesses that offer loans or lines of credit despite the challenges of federal regulations. While the number of women owned businesses has been increasing, the funding disparity remains evident, with women owned businesses receiving significantly less funding compared to the businesses led by men. The statistics for funding women of color owned businesses are particularly stark. Reports have shown that these entrepreneurs face even greater challenges in assessing funding compared to their own white counterparts. Less than 1% of venture capital funding went to businesses founded by women of color. This disparity highlights systemic barriers related to race and gender that hinder access to capital for women of color entrepreneurs. Despite their growing contributions to race and gender that hinder access to capital for women of color entrepreneurs in the business landscape. Today's topic will discuss the realities and equities of funding in the cannabis industry. Faye Coleman, can you please formally introduce yourself?
Absolutely. Thank you so much for having me here today. I appreciate it. My name is Faye Coleman. I am the co-founder and CEO of Pure Genesis. We are a minority women business enterprise certified with more than 250 years of experience from corporate to cannabis. Our mission is very simple. It is education, access, and advocacy. And as such, we look to be a cannabis provider, specifically in the dispensary realm. Our focus is we have 5 business entities where we have a cannabis license acquisition, where we're going to be opening up a dispensary in Atlantic City. We also have a line of beverages that we're going to be launching in Q1 of next year called Genesis, which we call the future of happy hour. We also have a trademark workshop called Now You Know, and we do business consulting. Our real focus is, though, we intend to be a community first partner. And by that, we mean bringing jobs to the community, workforce development, paying more than a living wage, offering scholarships and internships. 20% of our team will be through reentry programs, and we'll be doing profit sharing in the communities where we reside. So excited to be here with you guys today.
And we're excited to have you, Faye Coleman. Thank you for being here. Heather Malloy, can you please introduce yourself?
Yeah, sure. My name's Heather Malloy. I am CEO of Speedwell Partners. We are a private equity group that's focused on growth capital, so primarily looking at later stage businesses in the cannabis space. Prior to starting Speedwell, I ran mergers and acquisitions at a publicly traded company, which was fantastic experience in terms of looking at hundreds of companies and then also working on fundraising, both in the debt and equity market in the public arena. And prior to that, I helped start a couple of companies that were in cultivation, branding, and accessories. I acted as an angel investor in the industry. I applied for and won and then sold a license in Maryland. And that kind of was at the beginning of my journey in cannabis, which was about 10 years ago. And prior to that, I worked effectively on Wall Street, mostly, but like kind of through an insurance company. So right now, I think that where I sit best in the cannabis space, that my lane is working to help capital get into companies. And I think given a lot of the inequities and structural issues that you talked about at the beginning, um, we need more people that are tied to capital to have and take an interest in the cannabis space. Right now, it's a really difficult market. But so that's where I'm sitting. And like I said, mostly what I'm doing right now is like later stage growth.
Alrighty.
Wow.
Thank you, Heather. We're really blessed to have you here with us today. So let's dive into the subject matter. So, what type of funding is suitable? And is it loans, venture capital, angel investors, or crowdfunding, which aligns best with a cannabis business needs?
So are we speaking specifically about Faye's business in terms of what she's doing? Or are we just speaking generically about cannabis companies?
So it would specifically be about in general. So just cannabis companies in general, and then you guys can make your comments and
Okay.
everything.
So I think it's a tricky question for the industry right now. But I think for the most part, people starting any new business should be looking to take equity over debt. And that's because debt comes with promises to repay from cash flow that you don't have yet in a new business. And it can also come with a lot of conditions that constrain your ability to spend and develop your budget and pivot your business. And it will start actively potentially sweeping cash flow and tying up your assets, whereby if the lender is secured, you may not have the ability to pivot your business as you would if you had taken equity. I think that what I've seen is that for a lot of founders, it makes sense to work with safe notes, which is a simple agreement for future equity. There are template documents that are available online. And that simple agreement for future equity allows the company that's raising to effectively defer putting a valuation on their business so that they can get started with friends and family or other people that that have an interest in kind of supporting that founder, and it'll allow them to help them start the journey and wait to value the business. And then I think I would say also in cannabis specifically, I have seen some success with crowdfunding, but I think that crowdfunding is probably most impactful when you are connected to a big community. So if what Faye and her team are talking about is that there's a community of people that are, if it's a community first driven venture and that some of that community wants to be an owner of that business, crowdfunding can be useful, but it's a lot of work to execute a crowdfunding. The regulatory filings are really, really excessive and high. And for many cannabis companies, they've gone through successful fundraises and then had issues actually transferring the funds where they haven't been able to take the money because the platform has found from a regulatory purpose that they were not permitted at some stage in the game to move money to a plant touching federally illegal business. So you really need to know who the platform is and make sure that they've vetted the payments and the movement of cash right now while we're sitting in this Schedule 1 Netherland. But I guess that's what I would say. I would say equity would be my first pick. A simple agreement for future equity would potentially be a form that allows you to defer a lot of the legal work and valuation work. And crowdfunding can be an option, but it's tricky and it's pretty expensive. But I don't know, Faye, if that like connects to your business and the journey that you guys have had.
Well, we are probably totally on the opposite side of that, but I think that is preferred. Most certainly, Heather, and you articulated very well the value proposition around that. We just unfortunately did not have an opportunity to go after equity. We had to go the loan route. But as you're looking at monies, first you got to understand that you're raising capital for a startup, and what does that look like? And many people tap into their friends and family first in terms of investing, coming in at a lower price, of course, based on your valuation. You should definitely do that, and try to make certain you can secure as much funding as possible before you assume any debt, as Heather had shared a little earlier. But, you're going to have to look into, if you do have to secure debt, what's that going to come in the form of and who you're going to go after for that? Is that going to be an angel investor? Are you looking at VCs, which is what's swimming around a lot in the cannabis space? For those who have funds of other people's money and they're investing somewhere at 500K up, you've got to understand what that looks like for you and what stage of investing that you're in terms of what your needs are, so that you can understand how you need to make a deal. But first you've got to consider, what does your own project require? There are different types of funding out there, yes, but do you have all of the basic needs of understanding from your own business what you're going to bring to the table and how you bring it to the table? How much do you need? How will it be utilized? How will you pay back the debt? That's a very big deal, which we can get into. And I know we got some questions around that, but I didn't want to go on too far because I thought, Heather answered the question very well.
Right. So adding to what you all were saying, I guess my next question is, what are the terms and conditions? So I know that Heather gave some, but I guess I just want to know a little more on that.
So oftentimes, so I think that Faye's point right now is like market, the ability to raise money is like so dependent on the market. And right now, you have a lot of investors that have touched cannabis that have experienced massive losses in their portfolio. So they're not looking to deploy right now. And you also have a relatively high interest rate environment, which means that people that are sitting on cash don't have to take a lot of risk to generate a decent return in very low risk investments. And so it's a very difficult sale to get an investor right now to part with cash to do an equity deal. The valuation has to be very, very compelling, meaning what is the equity value of the company worth and how much of the company are they going to get? And then oftentimes they're not just looking specifically at the valuation. They may be saying that they want a guaranteed return. And so oftentimes companies get started, they're limited liability companies, which means that you have an operating agreement and the operating agreement sets the terms that the parties all agree to. And so oftentimes I've seen that first investor that's coming in with the riskiest dollars may structure equity that's very similar to debt. So it will be, there may be an interest rate on it that either pays cash or earns additional stock in the company. And it may be that they get a multiple on their capital guaranteed before any of the common equity is able to share in the profits of the business. And so I've seen terms like an 8%, a piece of equity that's effectively a preferred. And sometimes they're done as convertible notes instead, which just means it's technically a debt instrument that will convert to equity at a later point in time, but they'll have a lot of the same terms. And so it might be that the equity investor, if they're a preferred, would earn interest in cash or stock, plus they would get 2 to 3 times their capital back. And then at that point, once they've been repaid their 2 to 3 times their capital, then the founder and the common equity holder gets to start sharing in the return on the business. So it means that the profile for the founder, their payback is delayed or deferred because that investor has a preferred right to cash flow. And then I often see that there's going to be restrictive covenants in your operating agreement that are going to restrict the ability of the founder to sell assets, move money, sell the business, make decisions. It's going to be those initial investors, if they're big enough, and this is where like a friends and family round can be really good for a founder because the founder may have more control in setting the terms. You don't need to have a lead. You have a lot of smaller investors. Whereas if you work with like a venture capital group or a bigger investor, they may set terms and then they're going to be your partner making all of these critical business decisions with you because they're going to have rights based on the fact that they made that meaningful investment. So I would say it's about the amount of money that they're putting in, the percentage of the company that they're going to get, if they're fixing a minimum guaranteed return, and how much control they're going to want in the business. And I don't know, that's kind of how I would characterize some of the biggest decisions that you'll have to face as you look at taking in money.
Just in terms of adding to that, as you look at debt and coming to debt versus equity, clearly we're on the debt side of this, on the debt side of the coin. So it is very critical that you understand the terms of the loan that you're bringing forward, understanding the interest rate. Is it interest only? How many years is it? It's critical because you have a balloon payment at the end of that. So are you rolling it over into a takeout loan, which is like a traditional loan, which is more like a 25-year fixed loan with lower payments? Do you have interest reserves, which gives so many months before you have to start paying back the loan? So if you're actually building something out that may be, in your favor, if you do, it may come with higher interest rates or require more at closing. So if not, can you pay the interest until you open? These are the real questions as you consider if you're going to have debt to consider. The on the positive side, of course, you don't have to give any equity in your business if you're taking on that debt, but it is debt nonetheless. And you've got to understand if you default, what happens to the business. You have a personal guarantor that it's absolutely necessary. You want to make certain that you understand what's the default policy in terms of your loan, how that will impact your business. One, of course, taking your business away, taking your license away potentially, and then taking the personal assets of your guarantor away as well. So that's a critical piece that you need to understand as you're taking on the loan.
And that actually goes into our next question on how it would impact the business. And would it impact the business?
Yeah, so if you take debt, or if there's other restrictive covenants in what would like a preferred equities like debt instrument, there'll often be restrictions on how much cash you have to hold on to, how much money you can ultimately borrow, whether or not you can sell parts of the business or intellectual property or assets without getting consent. So it becomes that the financial partner, when you do these debt-like instruments, really is a business partner in terms of they're going to set like rails for the business, and they're going to want to make sure that you're performing within those rails. And if the business isn't, you may have to notify them. They're probably going to have pretty extensive reporting. And that's one of the other actual big things that I've seen for companies at really early stages, is that lenders can require such robust reporting packages that you really need to make sure that you have the right resources in your finance team to produce the information that the investor is looking for, because they may have to be able to close the books on a very timely basis and then give very accurate reporting on a cash basis as well, to let them know how much cash is in the business and what do the financial statements look like. So that, and I don't know if you've encountered that, but like it's real. Like some of the reporting requirements that some of the lenders are going to require you have to make sure your finance function is up to snuff.
100%. So we had to, and this is not to scare anyone, but we had to produce over 100 documents.
Wow.
So I mean, so not shy, not in the realm of 100, like literally 102 documents. So in terms of requirements for information, it is critical, especially on the debt side. I don't think it's any less on the equity side, but especially on the debt side. So Heather's absolutely right in terms of the requirements. They are heavy. You have to make certain you arm yourself with the right team as you're approaching something of this nature, this scale. You got to have a qualified CPA on deck. You got to have the right attorney on deck. You have to make certain that they understand not only their businesses, but the cannabis business itself, so that they can bring something forward appropriate for you. And also something that I look for is a broker. I call them a VC broker, Heather, if you will. That's probably all the wrong terminology, but for us, they got the job done. We really needed someone that was going to help us understand how to find who has the funding out there for us as we were looking, and to narrow that gap, to make certain that you weren't just engaging folks that were ideally in the space or limited in terms of what they can and how they could add value to your business. So you got to streamline in terms of how you pursue capital and make certain that you're armed with the right team to execute effectively.
One other thing I would throw out there is that you just kind of reminded me of this, is that so I've been working with some people in New York that have social equity licenses. And so it's been interesting to me to look at the terms that people have been offered. So I've seen a lot of cases where either the landlord wants to see a cannabis retailer go into the location, or an out-of-state operator that has multiple locations wants to come into the state. And the terms that I typically see being cast to the social equity applicant, and I would expect that this is pretty true for women founders as well, is that oftentimes the landlords are looking for things like above market rent and a rev share where they're maybe taking as much as 10% of the business, 10% of the revenue top line, which in a dispensary model based on the taxes right now, every penny is hard fought. And then they're also looking for like 49% of the business, or whatever the maximum permissible under the law is. So starting capital, like usually you see a founder that wants to do like 20 to 30%. They'll sell 20 to 30% to launch their business, is kind of like, that used to be like the rule of thumb I would kind of think about. And now I'm seeing initial shots across the bow are rent above market, revenue sweep off the top, and 49% equity. I saw multiple sources come in with exactly those deals. So very, very, very expensive capital.
Very expensive capital. And for us, we purchased our real estate outright. So we didn't have that situation. We'll go with that term. But you're right. It's just a pillage opportunity that's happening right now. And unfortunately, for those who can't afford to purchase their real estate and they are left with no other recourse but to lease, it is definitely a seller's market right now. And these agreements are predatory at best.
Wow. Okay, so I guess you guys went over the risks, but are there any more risks that would be involved in any of it?
So one thing I would highlight, this is for founders, right, that are looking at starting a business. So oftentimes founders start LLCs, and that means that you don't and I talked about this a little bit earlier, the percentage that you own of the business isn't necessarily the percentage of the business that you are entitled to in terms of like what the return is. But you may end up owning taxes in the LLC, and you may not get distributions. So when you are founding a company and you are taking in money and you are going to start going through what's called the waterfall, which figures out when people are getting their initial investment back, the business on an ongoing basis has to pay quarterly taxes. And the taxes fall to the members of the LLC, regardless of whether or not the LLC pays the taxes. And that is true unless you check the box to file as a C Corp. So if people file as a C Corp, then the business entity pays the taxes rather than the members. It's better and worse for different reasons. It's generally worse because it means then that there's two levels of tax. The business pays the tax, and then the members pay a tax on the distributions that they get. But it's really, really important for any founder to talk to a good lawyer and a good tax accountant and CPA to understand what the risks are, because they may be in a position where the business owes interest and they cannot deduct that interest under 280E. And they have other expenses in the business that they cannot deduct. And that means that there's profit in the business from a tax perspective, but there's no cash flow available to make those tax payments. So so there's many cases in the cannabis space where a business is taxably profitable, but there's not cash flow to make the tax payments. And so founders should really, really be cautious in going through this part of the investment and talking with investors about how money is going to flow out. and make sure that they're not in a position where they may have to be personally on the hook to pay taxes that they have no cash in hand to pay.
Okay, so going into our next question, should you consider the investor's track record or lender's reputation?
Yeah.
Yes. Absolutely. I just briefly would say that, do your homework. Do they have a commercial banking background? Are they accredited? They have a certain liquidity and net worth, in terms of those requirements. Do they have experience investing in real estate? Do they understand and have experience in cannabis, which certainly helps because then they understand where you are in the business and how you intend to move forward and what that looks like from a profitability standpoint. But yes, absolutely.
And I would say you're comfortable texting your investor, you're comfortable picking up the phone with your investor, you are okay grabbing dinner with your investor. If it's somebody that the hair on the back of your neck stands up with, you get a phone call and you're not sure, I don't know if I want to pick up the phone, I would not take money from that person. Because these relationships can be extremely intimate because money can become an emotional topic between people, especially if it's not an institution and it's a family and you don't know how important that liquidity may or may not be at some point in time. They may have expectations around when they get repaid that may or may not be reasonable. And so you need to be comfortable thinking about the downside scenario where if things don't go well, will they be constructive in helping you work through? And I've seen some amazing investors in the space that it's phenomenal when you think about the work that they actually sit and do with the founders to help make them successful. And then there are other investors that their style is more opportunistic and they will take advantage of the opportunity to take over a business that's been started when they can acquire a business that's worth more than the debt outstanding. And because they were a lender and because they're secured by the assets, they can effectively take control of the company and own the company based on the loan balance outstanding that's defaulted upon. So being able to like pick up the phone, work constructively, and feeling that they have your interests at heart and or that they're going to help you optimize the outcome. I have seen like really good outcomes and I've seen really bad outcomes, and it always comes down to people.
I 100% agree. It comes down to people. We actually returned a $10 million check to our investor because he was a predatory investor and he was refusing to sign the agreements required to understand what our business relationship would be. And he believed that we would be desperate enough to move forward as our application was time sensitive and he thought he could run the clock out on us. And as a result, move forward without any agreement in place at all. So Heather's absolutely right.
Well, good for you.
Right.
It was certainly a jolt to him. It was a jolt to us, but we move forward.
Right. So these are some possible solutions to our funding crisis. Investor diversity, encouraging diversity among investors and decision makers in funding institutions can lead to more equitable funding distribution. Access to networks, creating and supporting networks and mentorship programs specifically for women entrepreneurs can provide crucial guidance and connections for funding opportunities. And then we also have programs specifically for women entrepreneurs. I'm sorry. Then we have financial education. Offering financial literacy programs and resources can empower women entrepreneurs to navigate funding options more effectively. Policy changes, advocating for policies that promote equity in funding, such as providing incentives to investors, supporting women-owned businesses, or implementing programs that address systemic biases in funding allocation. Alternative financing, investment readiness is also another one. And and investment readiness programs, providing training and resources to help women business owners prepare for funding, pitches, and navigate the complexities of securing investment. Implementing these solutions collectively can help bridge the funding gap for women-owned businesses, enabling them to access the capital necessary for growth and success. Sending money blessings your way. And this is Shayla Taylor signing off from Women Grow. Everyone have a good night.